Okay, so as people come back in here, I'll just get started now, and I'll introduce myself as I go. But could I just quickly see, is anybody here on a startup or just thinking of starting? Okay. Yeah, I guess this counts. The forum counts, the meetup. Okay. So I'm a data scientist, and I use algorithms to predict if businesses will survive or fail. Any questions? No? How do we not fail? Okay, that's good. Yeah, I mean, 70 to 80% of new businesses fail. Some industries, it's as high as 90%. So chances are, if you just raise your hand, you'll be out of a job in a couple, within the next several years, right? It's probably not going to work. But yet we keep doing it anyway. And there's the interesting thing is it's almost like a lottery ticket, right? You just have to have a big success once, but so many times you fail. And what I'd like to talk about is this from the perspective of probabilities, and how can you actually find quantitative ways to improve what you're doing in your startup. And I'll tell you how we do that. But this is how we do it today. Let's face it, right? I mean, we're hearing a lot of principles, a lot of advice. We're all smart people, or you wouldn't be at an HPC conference, right? You make the best plans you can, you build your wings, and eventually you just have to launch. You just have to jump, and you just hope it doesn't hurt. And of course, most of the time, it's fatal. So, wrestling with this problem, I've started several businesses, but I was also in HPC business several years ago, actually almost 10 years ago, and just like today, walking around SC conferences, all the applications are simulation, right? Whether it's simulating the entire galaxy or the human body or protein or weather. And those are extremely complicated, as you know, scenarios. And a lot of times, when you look at all the death of startups, a lot of times people think, well, business is just chaos theory, right? It's all nihilist, you can't predict anything, the market's random, you don't know what's going to make it or not. Well, I don't think business is inherently less tractable than so many of the other things that we do simulate. So we might not be clairvoyant, we may not be able to predict everything about the future, but why can't we use these kinds of approaches to simulate actual marketplaces and startups to see what's likely to happen when a startup goes in there? So we don't just jump anymore, do we? When we're building an airplane, we do it in CAD, we simulate it, we do the wind and the shear and the drag and the lift, and if we don't like the way it is, we tweak a wing until we do like it. And the purpose of that is when you do finally launch the thing, the airplane, it's just a lot more likely to fly. I mean, you do have to go live eventually, but you work a lot of the bugs out using simulation. And that's literally what we do with startups and businesses. And while I can't show you all the things about how we do that, we're certainly not going to show you snippets of code. What I'd like to talk to you about are the things you're probably more interested in anyway, which are what are the principles? What are some of the themes we've found that make it much easier to predict if a startup's going to survive or fail? And I'd like to make a bet with you. I know it's the end of the day, you've been barraged with brain power all day, but if you just hang with me for the next 40 minutes or so, I bet you I can double or triple your ability to predict which startups will survive or fail for the rest of your life. Right? So the next 40 minutes amortized over your next life expectancy is good ROI. So stay with me. We can do it. If you need help, there's coffee. So let's just get right to the results, and then I'll go back up a little bit, because I'm very literal, so my wife tells me, and if someone says, hey, keep your eye on the ball, I'm like, now what, right? So you have to shout at me if you have a question. So what I'd like you to do, if you have questions throughout this talk, is just to interrupt me and shout them out. I use a lot of bad language, and I don't know if it's like an Asian thing in my family, but you might think we're fighting, and I just think we're finally talking, right? So you have to tell me what your problem is, because I don't want you to leave today with some thing I did that just pissed you off, or you just didn't buy it, and you didn't have a chance to throw it at me, because then the loss is yours, and I don't want you to have to go through that. Here's the results of over 3,400 predictions we've made using these algorithms over almost 10 years now. So this isn't the testing set. This is the validation set, right? These are all actual predictions we made in T0 looking forward over some point during the last 9 years. So if we predicted a business would survive, we were right 69% of the time. It's 2 out of 3. It kind of wobbles around 66%, depending on the update. Every refresh, it's a little bit different. We're wrong 1/3 of the time, right? So, okay. But remember, most venture capitalists and entrepreneurs, all the smartest people in the world, right now, the batting average is about 25% accuracy, right? About 25% of the businesses survive the first 10 years that get funding. So this is several times better than the best and the brightest companies and investors are doing today. So that's a huge thing. And how are we doing it? Well, we're not using intuition and guessing and wisdom. We're actually using data, and we're able to increase the yield. If we predict things are going to fail, we're right a lot more often. But I think we're right 2 out of 3 in either case. It's just that most things fail, so we get a little extra luck when we're pessimistic. There is a purpose for legal and finance. Just saying no can have value sometimes. If you add up the 2 columns, it's 83% accuracy, but I really I don't like to lead with that. I think 2 out of 3 is the right accuracy to keep in mind. Sometimes people anchor around the 83% because it's all sexy and everything, but I really don't think it's fair in terms of representing what we can and can't do. I wish, but we're not there yet. You can run all the statistical tests you want. It is statistically significant, 99% confidence. It's not luck. It's not like we're just saying everything will fail, and that's how we're getting right 80% of the time. You have to get survivors and failures to get the significance.
How do you define success?
Good question. So at the beginning of this research, we ended up in a lot of painful conversations about this. How do we measure it? Because we could never get 3 of us to agree what success is, right? Revenue, survivorship, strategic, blah, blah, blah. So I'm going to start in this slide with just alive or dead within 10 years. Okay? Now, so if it's alive but like puttering, we'll call that surviving. Okay? If it's just an old website that hasn't been updated in 6 years, I'll probably call that dead, right? It's like the business is gone, but they haven't discontinued their URL. So that's where the line sort of is. Any other questions before I leave this slide? Yes? No? You go ahead.
One more question. In terms of sample and population, this is the 3,000 closer to the population, or how much of a percentage of the overall population of startups are you tracking?
Oh, well, so these are just the 3,400 predictions we made that have matured as of today.
What would you estimate the population?
Oh gosh, much huger than that. I don't even know, like all the startups in the world. Tiny. But we did sample, as many industries and businesses, but yeah, it's a minuscule, but it's a pretty big sample. It's bigger than 30, right? It's all we got. So we've made a lot more predictions, but we have to, every year, more results come in because these are all forward-looking. You have to wait for something to live or die within the time. And luckily, you get a lot of results before 10 years are up because things become clear successes like a Facebook or they die. Okay. One more thing, and then we'll get on to how do we do this, because I think that's why you're really here, right? But a lot of people, especially as a venture capitalist, which I am, some of the criticism is, well, look, if you can just predict things, that's great, but can you catch the Googles, the Blockbusters, the winners? Because if you can't catch those huge, big companies, none of this really matters in venture. This is just a random sample of 80, but it's very representative, just to show, look, these things with 3x, 4x, 5x multiples in terms of their cash-on-cash returns, we tend to do fine. We don't always catch 100% of the blockbusters, but we don't have any disadvantage there either. We actually disproportionately do catch the blockbusters. We struggle the most with the things that are circling around 0, but it's still 2 out of 3, which ain't bad. And it's kind of weird because it's a 4x4, right? We predicted success, we predicted failure, there's actual success and actual failure, so it kind of fucks with your mind a little bit, at least mine. But that's okay. So what do I do for a living? The research firm where all the blinking lights are, where we do actual development, where we build code, it's in growth science. And that's just an itty-bitty company in Portland, Oregon. And it was important for me that the research paid for itself and had a business model. So we stuck it in its own little entity. And basically companies off the Fortune 500 for years, they give us data about new products or services or M&A stuff they're going to do. We run it through the algorithms, and we give them back literally a 2-page analysis of what did we find. And we've influenced over $100 billion in investments over the past several years. And $100 billion isn't a stretch. It's if I just get lazy and stop counting, you know, that's big enough. I don't think more will make a difference. But that's it. So it's not a consulting firm. Companies literally just give us inputs that we ask for. They fill it out online, and they get a report. So they pay to look at each deal and to get guidance. I also venture capitalist, so I'm managing partner at W.R. Hambrecht Ventures. If anyone remembers Hambrecht and Quist, they took Apple public and Genentech, and you know, W.R. Hambrecht is today's version. They did Google's IPO and a lot of other big ones. They did Rackspace, since we're here in HPC. So we're raising our fourth fund now. The first two funds have kind of matured, and now we're getting some performance data. And that puts us, it's not the hugest fund in the world, but just in terms of performance, already the first two funds are in the top 5% of venture capital funds for the last 10 years. So that's really good. I also support a sales and trading desk for W.R. Hambrecht. They have a stock trading group, and I ran a hedge fund, and all of those have performed in the top decile as well. So the point isn't to talk about investments. The point is, if you can really better predict which businesses will survive or fail, commercializing it is a no-brainer, right? Whether you're helping companies, doing venture, or stocks, it's all the same thing. It's just predicting if a company is going to rise or fall, and those are other ways to monetize it. But the good news is we've done it in all these contexts. It really does beat the market. It works. So that's me trying to say, hey, I think there's really something here. But let's get into our models, right? How do you predict chaos, right? Businesses, customers, and moods, and industry changes, and globalization. You know, there's all these things going on. And a lot of people just say, look, you can't possibly predict what some little startup is going to do. And that would be true. It would be chaos, except we believe there is a universal constant in business upon which you can make relatively stable predictions. And that universal constant is we're assuming that companies are doing their very best to pursue profits. So if you will, it's the rational pursuit of profit is a sort of unifying thread in all our models. And if you just know that one thing about companies, you'd be amazed about what you can predict, not just about just their behavior, but even the behavior of the whole industry as a whole. So we assume companies are at point A, and they're trying to get to point B, which is more profits. Right? And we don't know what big red block obstacles are going to show up over time. We don't know what path they're going to take. We don't even know if they're going to make it all the way to point B, but just knowing where they are and where they're trying to go brings some order into the chaos. And we're going to break into that. So that's underneath all of the models. So years ago, I was at Intel Capital. And it occurred to me, hey, wouldn't it be really interesting to build a data set looking at all of Intel's past investments, both inside the company and outside the company? And so I just started to do this. It wasn't my job. I just thought it would be interesting. And actually started to find some very early patterns that let us think we could better predict if startups would make it or not. And at the time, I didn't know I was doing this. It wasn't on purpose. But it turns out nobody's ever done that before. Nobody's ever tried to use a quantitative approach to predicting if startups will survive or fail. And it wasn't that I was trying to do this. It just seemed to make sense, right? And what do you know? It was novel. So some different professors were really interested in my work, and they'd heard about it. And I ended up, this professor at Harvard named Clayton Christensen, who, if you've heard of disruptive innovation, we've all heard of that now, right? But he's the godfather of that. He asked if I'd go spend a year with him at Harvard, and got me an office by his. And what he really wanted to do was bring all of Harvard's research and resources into what we were doing, so we could make the data much more robust and much larger than Intel's starter data set. So we did that. We spent the year at Harvard, and ever since, because what we really learned is our work dovetailed. The things I was finding in a purely quant sense were basically mirroring all the stuff he had already been writing about for a decade in terms of what's disruption theory and how does it work. I wasn't using his words, but we were finding basically the same thing. So, but since he's a very, very gifted writer, and he has 8 books, and there's books about his books, and blogs about those books, and I'm gonna borrow his language because I think it does a great job of vocabulary and articulating really what we found. So, has anyone seen the Christensen graph before? Yeah, some of you have. Okay, well, if you have, I'll try not to bore you because there could be a twist. But if you haven't, don't worry about it. We're going to give you the primer. Let's just say you have any product or service or software, it doesn't really matter, anything that's trying to make money, and it's a business. And let's just say you look at the performance of that offering over time, right? And we assume that businesses are always moving up market. In other words, these three lines here are what customers need. So at the bottom, you just have the low-end customer, just basic performance, just give me the cheap crap. At the top, you've always got the lunatic HPC customer, like way up there. They'll take anything that's better, and they don't even care what they have to pay for it sometimes. But we'll assume that most people are in the middle, right? These sort of pretend it's sort of the average performance customers need in the market from something. The blue line is technology improvement, and technology often improves faster than humans' lives change to absorb all that technology, right? So I'm not so young that I remember, you know, you'd bang on the old 286 and the green screen and you'd wait for the cursor to keep up, right? Keyboard latency wasn't good enough for a lot of people. But now, you know, it's overshot what any of us need. I mean, you'd never pay $50 more for a laptop because it had a few picoseconds less keyboard latency, right? Like, who cares, right? So it goes from underperforming to overperforming what we need. But why does it do that? Well, it's not just that there's science and universities and R&D. It's the pursuit of profit, right? So this isn't really a line of technology improvement. What it is a bunch of dots of product releases, of companies leapfrogging each other, right? They come out with better stuff. Intel, AMD, you know, we all saw that for a couple of decades. Why are they doing it? Because they want to have one-up their competition, serve those higher-end, top, best customers, deliver what they want better than anyone else. And it's not just R&D and research labs and Intel fabs driving the slope of this line. It's actually an industry agreement. So there's a business reason that gates the slope of the line. So we all look at Moore's law, right? Okay, we tend to think of that as a technical capability. Yeah, it is. But also, Intel announces to the world, hey, we're going to double our density every couple of years. So all the vendors and suppliers and coders rally around that timetable, which makes the shift relatively predictable as well. So it's not just technology, it's an industry sort of unspoken agreement on what the slope of that will be. Well, let's just jump into another industry, cars. Okay, so let's just pretend the blue line is Ford and Chevy, and you have the Chevy Bel Air, the Ford Fairlane. You know, these companies were one-upping each other all the time. And in the 80s, here came DeLorean, right? And DeLorean seems laughable now, but at the time, it was trying to be a really, really good car. It was trying to come in, not at the tippy top, but pretty up close towards the high end. I was told it was $60,000, which, you know, back in the 80s, that's pretty expensive. That's when houses were $30,000. Like, can you remember that? Okay, so they came in, but what happened? They were trying to take away some of the best customers in the industry. Well, look, if you're Ford and Chevy, you're just not going to say, oh, DeLorean's better, we quit, you know, you win. No, they have the supply chains and the history and the resources. They've been to all the birthday parties, they've kissed all the babies. You know, Ford, they own that market. And here comes DeLorean with better performance. Well, look, the incumbents just basically have two options. You know, I mean, they can give away their market to some startup, which they're not going to do, or they can just crush the life out of that startup and knock it off the planet, right? They have to kill it or buy it, but we found that statistically very improbable. It's low occurrence, I should say. So if you come in at the top of the market, you threaten the profitability of big, mean sons of bitches, and they will kill you. Not because they're mean, they're nice, you know, but they have to. They have to, because if they do nothing, you will take their business. And you're just a little startup, right? And it pains me when I see these startups in HPC. Remember Cortex years ago? They have amazing hardware. And they're, you know, in so many benchmarks, they actually are better than HP and, you know, IBM and all these folks. And then they're gone. And everyone's like, how could that happen? There was a great team, great technology. They listened to the customer. Well, IBM's not going to be like, okay, Cortex, you win, we quit. No, they're going to kill them, right?
Yes, you said it around 2 times. So.
Yes, please do. And shout if I don't see your hand.
So I have two questions. One of them might sound really stupid, but it'll kind of get through it. So when you say pursuit of profit,
money.
Okay, good. So do you consider, companies like, to some extent in the early days, Amazon, companies like, even Facebook, I mean, companies that really went after either increasing revenue with no sight of profitability, like Amazon, or just increasing subscribers or moving it wide. Not Facebook specifically, but you know what I mean?
Yeah, or Twitter, right? They still can't figure out how to make money, really.
But if those companies become successful in the sense that they actually exit, assuming that goes to success companies,
Usually does.
so are those outliers, or do you predict those?
We haven't noticed a statistically significant difference between sort of the Twitter, Facebooks, if you will, and even the early Adobes, if we're going to go way back, right? Giving away PDF and so forth, right? And some of the more sort of standard business models. So they're pursuing profit, yes. They don't always know how they're going to get there. But you can almost think of it as winning the market will lead to profits, even if it's ambiguous to them.
So it's basically like, winning their market is a milestone to step on to then become, turn into advertising revenue, whatever it is. But you consider that still a decision point?
Yeah, in fact, we don't have to know exactly what that will look like. We just know that somewhere it will drive their choices. And giving it away to get it full, to capture the market and then monetize it is something we see quite often. Okay, well, so what do? You can't just go take them on head on, right? Because yes, sometimes, I mean, Tesla did, right? And they're around. So we were wrong about Tesla. They came in just like DeLorean, right? Really expensive, beautiful cars, and they've survived 10 years. So, okay, that's fine, right? I'm a scientist. We were wrong. I've been wrong, I think, over 900 times so far. I mean, we're wrong a lot, right? We just make a lot of predictions. But
I would have to say that's very different than DeLorean.
well,
Because he didn't use a typical supply chain. He used standard method of transporting fuel. He was outside of what those two companies already failed to do.
yeah, well, certainly there were differences between DeLorean and Tesla, and I don't know the industry enough to even get into the nuances that far. But I'm going to lump them together in that they did come in trying to take away some really great customers. Okay, so for today, we'll go with that. But, so we were wrong about Tesla, but they're an example. They're that sort of 9%, if you remember a few slides ago. We haven't gotten to that slide. So in that case, they'd be in the 33% or so that we missed. Now, they did, go bankrupt once and almost twice. It makes us feel better, but we're still wrong. The scientist in me can admit that. So what do? Well, there's some other strategies, right? This is not just one strategy. The black and white picture is Toyota. It's the Toyota Corona, 1957. Toyota was a startup here in the US. And I wasn't obviously around in 1957, but I've been told that it was the worst piece of crap anyone had ever seen. Right? It could only go 45 miles an hour. Like, man, right? And it leaked oil. But as embarrassing as it was to drive around in a Toyota Corona, it wasn't as embarrassing as walking or riding your bike. And for some people, yeah, it wasn't great, but it was the first car they could afford. Down here, if you will, at the low end. So there were customers who were, just glad to be in a car, and they could actually afford it. But a couple things happened. Well, first of all, what do the big incumbents do when someone comes and starts converting walkers? Is that attacking their most profitable business? Do they care? Is it subtracting from their P&L? Well, maybe not at all if these people were walking. But if they were buying cars and they switched over to Toyotas, these are the crappy customers we're all trying to get rid of all the time, right? Not all customers are equally desirable when you look at their profitability. So cost accounting is the very science of figuring out which products are more or less profitable, divesting your least profitable products so you can spend more money on where you make more money, right? That is cost accounting. That is the rationality behind business choices. And knowing that, we know which battles they have to prioritize and which they can safely ignore in the short term. But as we know, in the long term, it can play out very, very differently. Now, Toyota had a problem. They were down there. They said, okay, nobody's threatening us. Like everyone's letting us have this market. but we have to figure out how to make money at the low end. And back in those days, dollars, it was around $1,700, but even then that was really low for a car. And so they couldn't build cars with vertical integration and huge factories and everything the way the way Ford and Chevy did. Toyota had to redesign the whole car to use 25% fewer parts because they had to make money down here at the bottom. And the other thing they did is they came up with the Toyota production system, TPS. The early, everything that's lean and Six Sigma sort of came out of this astonishing revelation of Japanese manufacturing once upon a time. What's that? Right, and I forget what but I call it the Toyota. I can pronounce that. There you go. But why did they do that? Why did they get so lean? Not just because they were inherently efficient-oriented people. No, they had to make money at the bottom. But once they did, and they could be profitable, then what happened? Well, they just started making slightly better cars. And eventually, every time, they were inherently lower cost, and just pretty good. And here we have them going all the way up through the decades to the Lexus. And a few years ago, Toyota was the biggest car company in the world. The American car companies were bailed out or penny stocks. And this is a complete reversal of an industry. It would have been unthinkable at the time. But we found that it's not a one-off. It's relatively predictable. So just for fun, just to prove that point, okay, so if you buy that, who's maybe even cheaper and worse than Toyota a while back and now is doing exactly the same thing to them? Hyundai and Kia, right? So I remember when I was a teenager, true story, I saw this white Kia Sorento, the SUV, and I was kind of a shitty little teenager, and I just remember being offended at the sight of it. Not just that someone would build it, but that someone would buy it. I was just like, ew, it offended all my sensibilities, right? Well, now, when I got out of business school a while ago, I just had a child, I was out of business school, needed to find a job. What did I buy? A white Kia Sorento, right? Because by then, they were damn nice cars, right? I'm like, oh my God, like it's an SUV, safe for the kids, like 100,000-mile warranty, 16 airbags, you gotta be effing kidding me. Like, it's awesome. Have you seen these things now? Like, I don't even work for Kia. They're leather and they're 40 miles to the gallon. They're fucking awesome. So the point is, it's predictable. Now, just for fun, fourth line, even cheaper and worse than Kia. Maybe this is like just fantasy world, but maybe even come up and do the same thing in some future decade. Tata. Tell me if this sounds familiar. Tata Motors built this little car called the Nano, and it's $3,000 retail. And they had to figure out how to make money. So they completely re-engineered the car to use fewer parts so they could make it at this low cost point and still make money. And they tried to manufacture it in the other Tata factories. It just fell apart. There were strikes, there were lawsuits. I mean, this is in India even, right? And so they had to figure out completely different manufacturing processes to get it done. That's the kind of thing you start to pay attention to once you realize what's going on, okay? So this is all out there. This is all published. Christensen has written all those books. And I actually encourage, he's a wonderful writer. Even for an academic, it's beautifully written. It's almost prose sometimes. But for the rest of today, I'm not going to talk about anything published. We're going to go to the unpublished world where I live. And I never publish anything, neither do any of my colleagues, because it actually works. Right? You don't publish shit that works. But I will show you how this kind of happens. When I first met Professor Christensen, I said, how predictive is your theory? I said like 12%, 13, 15, because as a manager, a great theory is one thing, but if it's 12% predictive or 100, it really matters to me as an entrepreneur or an investor. But that matters. And that's the difference between the best theories in the world and the real world we live in, right? These details. And it's really easy once you have the data. Well, look, if you have that sustaining strategy, and that's what we're going to call that DeLorean strategy, or that better performance, that blue line. Better performance we'll call sustaining. That's a Christensen word. And of course, there are algorithms. This is the premise, right? If you're already a big fat incumbent, you come out with a better performing thing, those actually survive about 2 out of 3, about 66%. Here it's 63. And that doesn't surprise us, right? I mean, if IBM comes out with next year's even better servers, those generally tend to work. Intel comes out with another Xeon Sometimes they don't work, right? Like a very high-end Intel processor a few years ago we won't mention. Most of the time they do. But if you look what happens the minute you're not the incumbent. Same strategy, better performance, but this time you're the startup, or you're new. You could be a big company going into a new market and still be a new entrant. It's new to you. Your odds of survivorship shrink to 9% as of the last update. 91% chance you will die, which is worse than 25%, which is the natural average attrition rate. This is what we call a bad strategy. Don't do this. If that's the only thing you remember today, don't do it. And this is about 90+% of all the pitches I get as a venture capitalist. They're all this. Not all of them, because obviously you find the gems. But in HPC, it's worse. And that's why it's so hard to find good startups in HPC. And I came from HPC. I genuinely have a passion for HPC. But it's really hard, because in HPC, we're always trying to build better performance. Now, there are exceptions, but that's a problem we really face. Just because you can do it doesn't mean you can be a new entrant and do it. Look, if you can build some new, you can get more petaflops out of a system, and it's just better performance, well, that's fine if you're IBM, but if you're a startup threatening IBM, it's really bad, statistically. There is a strategy that's worse than this. Empirically, we found it's, memory serves, if you're new, you're way more expensive and you're way worse. That's it, though. This is the second worst thing you can do. Okay? So I know it's hard. It's not what you want to hear. But this is the truth. And HPC struggles with this so much more than so many other industries do. But there are examples of success. They're just not as many as I would like. So what do you do? Well, what about that disruptive strategy, right? Well, check this out. It turns out if you have a disruptive strategy, and we would use this in an extremely narrow way, but we'll give you the sense. Look, it doesn't matter if you're an incumbent or a new entrant. Look what happened to your odds of survivorship. They go back to about 2 out of 3. And that's the second big takeaway of today. I've literally just told you that startups can have the same survivorship odds as big companies launching incremental new versions of their products. And we've seen this firsthand with startups and big companies for years. It really does work in theory and in practice. Now, the low-end disruption we just talked about, cheaper and worse. Think of those as the 2 elements. It's got to be cheaper, and it's got to be worse. Okay, you HPC people, it's got to be worse. It can't be cheaper, better. We looked that up, like the odds are the same. You go back to sustaining. Why? Because if you're cheaper and better, you're going to threaten the incumbents. If you're cheaper and worse, they look at your booth and they're like, ooh, that doesn't bother us. Like, pfft. Hey, you know, if they're laughing at you, you're probably doing something right. If they're pretending to partner with you, that's not good. Everyone's like, oh, look, they're going to partner with us. Now, that's called spying. Don't do that. Okay, but so the most popular disruption in the literature is the low end, cheaper and worse, but it's only about 18% of the disruptions that we've cataloged to date in our research. So actually, it's not the most common disruption, even though it's the most famous. The new market disruption is the most common and a little bit higher in magnitude. They tend to be a little bigger, although it's not always the case. So what is this new market disruption? And we're going to unpack that for you today, too. But basically, it means instead of going cheaper and worse, you go off to some market nobody gives a shit about. So in either way, the incumbents don't care, right? Because you're down at the low end or off their radar. And they just don't care. The causality is the constant. But we're going to make that much more specific for you. Questions before I leave this slide? Oh, one more thing. People ask me about technologies all the time. Thomas, what about electric cars? Thomas, what about this? What about that? What about Flash? What about... Technologies are neither sustaining or disruptive. Technologies are always neutral. Like this glass is a technology. It has none of those characteristics, one or the other. This looks at your strategy. How do you plan to take that class to market? What are the customers you're going to serve? What are the features you're going to work on? It's all about strategy. Look, the electric car, for Toyota, the electric car was just better performance and they were an incumbent, right? The Prius. Toyota was a car company. This was better gas efficiency. Or, if you're Tesla, it was better performance than a new entrant, but they ended up in the 9%. Thank goodness Elon Musk has so much money. Or if you just came in at the low end with electric cars and found a way to get started there, right? Same technology, different approaches. Yeah. Oh, God. Well, we started by boiling the ocean, right? You know, trying to see which variables were weighted, and then as we started to find some, you know, refining and narrowing, focusing on them, seeing how much of the R squared we can account for, you know, tons of control groups. But yeah, nothing fancy or new, just, you know, really back-breaking kind of stuff. The only reason it seems qualitative is because I'm not going to show you our code or talk about the secret stuff, right? But directionally, right? And that's, again, what I hope to accomplish in the last few minutes is, you know, we actually have to run all the algorithms to know, you know, if a company's paying us or we're going to invest, we do all that. But about how, and that's what you can take away. You know, you just know if a company is trying to be better than everybody else. And if they're a startup or new, that's a no. Or if there's some down, you know, cheaper and worse, or in some new market, they're a maybe. But getting rid of the no's is hugely efficiency driving. And as a startup or an entrepreneur, you've got to resist that temptation. And every time you think of pivoting in that direction, you don't. You can see why that's tough. And I can't, you know, as a business owner for the research firm, you know, it's amazing how I will rationalize anything. Right? Oh, no, they're not competitors. They want to partner with us. Or whatever, right? No, no, they don't see us as a threat. No, 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 no. In fact, they probably will be a good channel for us. Like, wrong. They will kill us. Right? So it's hard. But we have to have those honest conversations with ourselves. Okay, so what about this new market disruption? Let me be more specific. The new market one, right? Just the new market one. Well, look, here's how I would like you to look at it. You have a customer population. And down here, you have the money, skill, or access you need to be a customer, right? So if Cray gave me a Cray, so I didn't have, you know, I can't afford a Cray right now, right? They're pretty expensive. But if, let's just say, it was free. Well, I personally don't have the skill to turn on a Cray, like where's the on switch? Like my CTO would have to do it, because I don't even know how to turn one on. But let's just say, you know, we got a Cray, it was free, my CTO comes in, he turns it on. Like, where will I put the Cray, right? I can't put it in my office, because, like, the whole building's power would probably go black, right? I mean, like, I have other problems. Access can be physical or geographic. There are literally things keeping me from being a customer. So, some customers, there's a lot of customers that have no money, skill, or access, or some combo. And then there's a few customers that have all of the above, right? Okay, fair enough. And there's always a Pareto distribution, regardless of industry. It's different slope. So let's just pretend this is today. You have to have at least that much money, skill, or access to be a customer for something. Maybe that's HPC, right? Maybe that's, you know, it could be anything you want. New market disruption asks, what about these people? So it's not any new market. It's not white space or blue oceans. No, it's what about these populations who are not customers today because they don't have the money, skill, or access to be customers. And if you can innovate, let's say here, you lower the money, skill, or access to be a customer, let's say this far. And it's hard. It's hard. Those are innovation barriers. Those are challenges. It's not easy, right? But if you can do that, look what happens. If you're here and the whole market is here, and they're all moving this way. Why? Because they're pursuing the best customers, right? So they're moving to the right. If you show up here, do they care? Well, you're not in their market. You know, if you get the TAM from Gartner or whatever, it's like here, that's the market, right? This doesn't even count. So nobody's going to bother you. And you start moving up market, and just look at all this surface area you accumulate. By the time you even get to the old market, you could be bigger than it. NetApp did this, right? Started out these cheap storage boxes, kind of crappy, plug them in with an Ethernet connection. I'm sure that's not how they would describe it. But you know, a small business or whoever could just stick one in. Now, rumors, I could be corrected because I wasn't around, but I was told they wanted to go to HPC, but they just really couldn't. They just didn't have the technology. Well, back then, and it's close today, the whole HPC market, software service, was about 10 billion. I don't know if that's changed. By the time NetApp started getting to HPC, their revenues every year were approximately 10 billion. They became as big as the market that they otherwise would have started in. And that's why these become such big disruptions, they called. Okay? The refrigerator, the first commercial refrigerators, another great example. So it used to be, in the 1800s, this is how you got ice. Like, you had to buy it from somebody who had cut it out of a lake in New England. There were times in the 1800s where ice was America's second largest export. This was an ice country, right? You had to have an amazing amount of money, skill, or access to the physical act of producing an ice cube. And when this came out, any idiot, I don't need to know anything about, I don't have to have access to New England, I don't have to have ships and ice houses, and I don't have to have any of that. I can make an ice cube. So that's what we mean by a new market disruption. Now, it seems kind of silly, ice. It's like, that's. But this is literally people used to have to go buy ice all the time, especially if you're a clinic and you have cold vaccines. I mean, can you imagine? If you're in the Caribbean, you can't get a cold drink, unless it comes from New England. The same today would be if you could just make gas, you could go to Home Depot, buy something, plug it into your garage, and make gas. You wouldn't have to, that's the magnitude of disruption that this was. Okay. But we know how they got there, which is every bit as important. So just for some examples, here are some companies, and I just thought you might want some examples. They're disruptive right now. A lot of these we've invested in, but they're everywhere, right? Disruptive companies, yes, they're a minority of companies, but there's just so many companies. You can find disruptive companies all over the place. And in any industry, in healthcare, in mining, in tech, and even in HPC. But HPC has extra challenges because the temptation is always to be higher performance. So I think I owe it to you to at least kind of see what these look like. So this is just the stock performance for Intel, ARM, NVIDIA, and AMD. Up in this box, I'm going to show you, it's just a simulation, right? Making it took several years, right? And you spend a lot of time in the lab. But once you have it, you just sort of run it. The red line on top is going to be Intel. So here's Intel winning, and this orange line, ARM isn't doing anything. And then it's like, oh, shit, what's happening? Ooh. Yeah, that's not good, right? So if I'm Intel, I should be concerned with that. And if I'm ARM, if I'm going to invest, I might want to invest in ARM, right? But of course, there's lots of randomness and things we don't understand in the real world. So we, of course, introduce a lot of randomness into our simulations. And every time we hit enter, the lines dance differently. What you have here, though, is a set of rules and conditions. We plug in each company, and we let them fight to the death. And we do it virtually. And we can make all kinds of tweaks and what-if scenarios, and it's all virtual. And you do these simulations in batches, and you just see, if I ran 2 million iterations, right, what percentage of the time does this happen? Is this only one fluke? Does Intel have nothing to worry about? Or if I run it enough times, is it enough of a percentage to cause worry? So like any HPC thing, right, that's the kind of process you get involved with. Okay. If anyone's curious, Under Armour, Nike, same thing. Under Armour started out as spandex underwear, right? And now it's Nike's #1 threat. It wasn't even, it was between your underwear and your gear. Nobody cared about that. But now, of course, it's expanded. So as you're a startup, if you've all read your Lean Startup, you should have if you haven't, but as you're iterating and you're pivoting and you're doing all the things you spent today learning about, we use simulation as just another, it's a great way to quickly test drive your next pivot, right? See what the odds are. If the odds are good, that's nice. If they're bad, you keep correcting before you change your actual business. Right? So it's a nice iterative tool. That's the beauty of compute, right? It's almost free and super fast. 5 minutes, okay. So here's a few mistakes, and then I want to stop and do a little questions. But if I'm to summarize, and I'm going to get a little bit off script here, here's the 3 biggest mistakes I see, both for startups and companies launching new products and services. They always underestimate the competitors. I can't tell you how sick of that I am. Like, no, we're nimble, we're smart, we're cool, right? We're startup. They're big dinosaurs, slow, we'll kill them. It's like, no, if you attack their core business, you'd be amazed how nimble they are, right? I mean, Intel pulled its quad-core roadmap in like 3 years, like back in 2008, because they were feeling particularly threatened in servers, of course, by AMD, which was tearing it up back then. Like, that was amazing. That's nimble, right? If you attack their core, they're nimble. The other thing is, you always underestimate what it's going to cost. We all know that. But the other thing is that companies underestimate the impact of their internal corporate forces. The point I want to make there is, once you find a business model, it defines your capabilities every bit as much as it defines what you can't do. Just like those competitors, you will inherit fights you can win and fights you can lose. So if you go into a market and there's somebody, and you start your business, and there's someone more disruptive than you, your corporation, your business, your people, no matter how enlightened they are going to react the same way. They're going to say, oh, we don't care about that. That's worse than us. We're going to focus on these more profitable markets. So at scale, these things play out the same way. So you just have to be aware that the organization will have its own inertia. And as leaders in the organization, it will be a force of will to combat things that start to disrupt you. And those can happen way down the road or right away. And it's a lot easier to disrupt a teeny company that doesn't have a lot of staying power. Last thing, just technical, right? As a VC, here's how I would do your slides, like literally, bullet points. Question 1, what's the big effing problem? Like, the first slide needs to tell me why I care. And it should be one picture, and you should not have more than 10 words on there, including your name. Right? Like, if I don't care, it has to be an emotional connection. You'll lose me after slide 2 if you don't get me on slide 1. Okay? Just imagine, short attention span. Think of it like a fruit fly, right? So it has to be emotional. A picture of it's horrible. A picture of a sick kid is 1,000 times better than the picture of a test tube. I have to care, right? And I'm a data-based VC. The others, they're not all, there's different kinds of VCs, but most of all, they're even more susceptible to this kind of thing, right? Because I go back to an algorithm. They go back to their intuition. Slide 2, competitors. Now, most of you don't like to have this slide. You don't want the competitors in there unless it's a chart showing your competitors and all the performance, and you're the one who's better at everything. Like, you know that chart? Have you ever seen that chart? Like, and you put a few logos of the competitors you have a good answer to, but like the ones that you don't put on the slide, right? Or have you seen that, right? Or I've behaved that way myself, right? Before, literally, and this thing, it sounds mean, when I see competitors, or if they don't bring them up, or if they do, I am, as a VC, they're pitching me, I'm Google searching competitors. And if I find competitors, I will stop what they're saying and call them on it right away. And if they don't have an answer, and especially if they never brought those competitors to my attention, I will hold it against them, right? It is a sign that they are not being straightforward with me. So, yes, these are my competitors, and they're fucking terrifying. That's the slide I want to see. You can then tell me what you're going to do, okay? But don't you dare shortchange the competitors, because everything we've talked about today, disruption theory, it's all about competitive dynamics. Don't do more than 5 bullet points explaining your solution. HPC people, right? 30-point font is the smallest you are allowed to use. Got it? 30. No adjectives. You have to tell me why you're going to win, but you can't use words that end in ly, right? Like, it's a really good product, or it's, don't use breakthrough, or, just don't use adjectives. My brain has, like, cognitive dissonance. I'm trying to get them out of my brain because I'm trying to actually know what you're doing. They're just they're distractions, right? This is a, what's that? I hate that, right? It's a filler. Like, your brain does that, right? You read stuff, and you're busy, like, trying to get rid of the crap to figure out what the real message is. Make that easy for a VC. And if you can't, maybe your business isn't very good. Right? Time to pivot. And then the existing solution, your go-to-market strategy, it can be the littlest market in the world. I know VCs want big markets, but you need to show them the beachhead. You can't take all of Europe. You got to start on the beach, right? And then you're going to quickly show me where you're going to go. Like Toyota. Yeah, we're going to start with the cheapest, worst car anyone's ever seen, but if you're walking, you're going to love it. And we're not going to stop there. We're going to march up and take, like, all cars everywhere. Don't get me wrong. It's a huge market. But I don't want to hear that you're going to take the huge market on day one. I want to know where you're going to beachhead, and then show me a plan, even if you're just hand-waving a little bit, for how you're going to grow from there. And then everything else that you've been dying to tell them, all your charts, the math. Don't do the math, by the way. Just don't show them math. But, like, everything else that you're just dying to say, you can put it after that, because they're going to stop listening anyway after slide 4. And they're not going to listen again until the end when you show them your team. And the last slide is the same as the first slide. You have to remind them with that feeling of the sick child or whatever it is that makes them care. Right? And they will remember that picture and that feeling more than anything else in slides 2 through N. Okay? So that's just one man's advice. That's what I would do, and I love seeing these pitches. So this is my favorite picture in closing of someone who doesn't understand probabilities. So I don't know what the future, I can't predict the future, right? You're all scientists. We live in a world, the only thing we can hope to do is get a grip on the probabilities and improve our odds, right? I mean, that's realistic. But I hope you've seen today, and I hope I haven't overstated, but I hope I haven't pulled any punches either. We literally live in a time where we've used data to switch innovation. And if you know this, you can stop being the gambler, and you can start playing like the casino. And we all know where the money flows. Even if grandma, it's not my grandma, it's some Google grandma, right? But even if she has a big day at the slots, what's going to happen if she just keeps playing? The money flows back. And we've literally made enough of an impact to shift the odds from gambling to risk management. And that's the difference. Now, we have so much further to go. I can talk all day about the times we've screwed up and been wrong and what I'm trying to do better. But we've made progress that makes a difference. And I hope it can change your lives and your businesses going forward. Thank you very much.